operating working capital initiatives. Now, friends, at this point in time, I would like to mention that research shows that across the globe, 90% of the times when a business closes, the reason is bad working capital management. And it is also noted that the businesses who do well are the ones who have a very tight and efficient working capital management. And therefore, for every business to realize its purpose of creating value by making profit or making profit by creating value, management of working capital becomes very essential and it is absolutely imperative. And I would say at this point in time that the management of working capital is not the responsibility of one person in any organization or of one department in any organization. Working capital, as we would notice, is the responsibility of everyone. Working capital management is the responsibility of the accounts people, finance people, marketing people, procurement people, production people, HR people, IT people, security people, everyone in the organization has a responsibility and role to improvise the working capital management of any business. And as I said earlier, and I'm repeating, tighter and the efficient, more efficient is the working capital management of a business. Better is the profitability and performance of that business. That is the kind of relationship that we have in the working capital management. So friends, we would be stretching this session by another 10-15 minutes. I hope that should be okay with every one of you. The whole idea is to cover the working capital part of it is today, so that you will have an opportunity of playing this game second time, and second time when you play this game you would also be able to apply this understanding of the working capital, and this you should be able to do soon after we close the session today. So what is working capital management? First of all, please remember, as I mentioned yesterday, in a balance sheet you have current assets and you have a current liabilities. Are all the current assets your working capital? Answer is no. And why answer is no? Because inventory is your working capital, is part of your working capital. Receivables are part of your working capital. Cash and bank balance can also be said to be part of your working capital. But the short-term investment that a company makes of temporary funds into the securities of other companies, is that also part of the working capital? Answer is no. It is a current asset, but it is not part of working capital. What is part of working capital? Only those assets which impact working of the company, only those assets, those current assets are part of the working capital. So therefore, primarily friends, we talk in terms of operating working capital. And what is operating working capital? Operating working capital is inventories and receivables minus the payables. Inventories plus receivables minus the payables, and the difference is known as operating working capital. Operating working capital. So as you can see on this screen, what you see here is inventories and customer, and on the right hand side is supplier, and the difference that you see.
Please share your screen.
All right, okay, please, thank you so much, thank you for reminding me. I'll just do it. Friends, is it visible now? Okay, thank you so much. Thank you. So, as you can see on your screen, what is operating working capital? Please mute yourself. Please mute. What is working capital? Working capital is on one side inventories and receivables minus the payables or trade payables or the money that we have to pay to the suppliers, that difference is known as operating working capital. And this is, friends, what we have to focus in our business for creating value and by making more profit. Having understood what is operating working capital, I'm sure you can very easily understand. For any business, shorter the working capital cycle, better it is going to be for that business. Because if the working capital cycle of a business is long, that means what? That means inventory is held up for a long time. Receivables are payment from the customers are received after a long time, and the payables are paid early. That means this company will have a very long working capital cycle. That means so much of company's capital is going to be locked up in the working capital, and that is not a good sign. So in principle, when we talk in terms of tightening of the working capital management, what we have to do, we have to work on how to shorten the working capital cycle. So shorter the working capital cycle, lesser is going to be the amount of the business in locked up in the inventories and the receivables, and that much better it is for the business. How to interpret operating working capital? Now I'm sure, friends, this question we have discussed many times. It is very difficult to figure out by looking at the number of OWC, whether this OWC is good or this OWC is not good. And this is what we have discussed in the context of so many things. So whenever you have to look at a number, you should be able to benchmark it. So how do you figure it out that the operating working capital of MRS is good or not good? How would you figure it out? You convert this OWC in a ratio by comparing it with the sales of the company. So operating working capital, OWC, operating working capital divided by the sales of the company will give you a percentage. So here let's say for example, we get a percentage of 20%. That means my OWC in the current year is 20% of my sales. Now whether I have done good or I have not done good, how do I find out? I would calculate the OWC to sales ratio for my last year and see as to what was my ratio last year. So if my ratio of OWC to sales last year was 15%, and this year if it has become a 20%, everybody, good sign or bad sign? Everyone.
Bad sign.
Bad, good sign or bad sign? Everyone. Bad sign. Bad sign. Bad sign. That means what? That means I'm holding more operating OWC, and that of course is a bad sign. But if my last year my OWC was 25% and this year my OWC is 20%, that means this year my OWC management has become good, better than last year. What can I also do? I can compare my OWC, my budgeted, my actual OWC percentage, OWC to sales ratio with my OWC to sales ratio of last year. So if my last year's ratio was 25%, this year's ratio is 20%. That means in this year, company as a whole has done a very good management of its OWC, and thereby it has been able to bring the OWC down in comparison to the last year. And that is a very good sign. So remember, as a principal, every one of us need to work on how to bring the OWC down. We need to work as a principal for good working capital management as to how to reduce the working capital cycle of the business. And that is how, friends, we would interpret the OWC level. Now, working capital is the difference between the current assets and the current liabilities. But remember, as a strategy, instead of focusing on the working capital, we focus on the operating working capital. And why on the operating working capital? Because the major component of the working capital comes from the receivables, inventories, and the payables. And therefore, the Pareto's rules, I am sure all of you would know Pareto's rules, 80% of the sales come from 20% of the customer right? Is likewise, what we need to do, instead of focusing on C items and B items, let us focus on the A items, because 80% of the results should come from 20% of the activities, and that is how the operating working capital is calculated. So how do we calculate the operating working capital? Inventories plus receivables minus the payables. Now, there are certain initiatives that we have taken in our company, and what are the objectives of these initiatives? Number one, present the OWC initiative within Emaris. That means let everybody in the organization be aware as to there is an initiative taken by the company for improvising the OWC. Number two, understand why reducing the operating working capital is key for Emaris and for you, for every one of us. So please pay attention. It's very simple. It's very simple. If a company is holding too much of inventory, if it is holding too much of receivables, that means what? That means this yeah, please go ahead.
Working capital will increase.
Working capital will increase. Excellent, excellent. Working capital will increase. As a result of that, companies' bank borrowing for funding the working capital will also increase. And if the company's borrowing for funding the working capital increases, that means what? That interest liability also will increase. And that is the reason as to why we need to understand as to how higher working capital will impact the company adversely. Point the various leverages enabling to improve the working capital. Now, all of us, all of you, please tell me, if a company has to improve its working capital management, according to you, what three things this company should do? Everyone.
Reduce the inventory.
One is reduce the inventory.
Debtors in well before time.
Absolutely. So work on reducing the receivables, and that's number two. Number three.
Increase payment terms.
And
Days.
and increase the payment days to suppliers. That means negotiate with your suppliers longer credit period terms, and so that you are able to finance your working capital with your suppliers' money. And these are the levers for improvising the working capital of a business. Some key points, friends, key idea is profit is not cash. We have understood it earlier in the morning when we discussed profit is not cash. I have earned a profit of 100 million euros, but my inventory has gone up by 50 million euros. My receivables have gone up by 120 million euros. I am not in cash. I am not in positive in cash. I am in negative cash. Sale is consuming cash. Please remember, and this is what we must understand forever. It is said, sale is complete. Sale is complete not when the invoicing is done, not when the goods are shipped. Sale is complete only when money from the customer is received by the company. So sale is consuming of cash. What is really is helping? The sale does not help the company. What helps the company is when the cash is received from the customer against that sale. And that is what we need to remember. Each euro in inventory also represent cash that cannot be used. So if I am carrying too much of inventory, I am carrying inventory worth 100 million euros. That means 100 million euros are locked up in the inventory. I cannot use these 100 million euros for the use of the business, and that is what we need to bear in mind. As I said earlier, please remember, across the globe, 90% of the times when a business closes, reason is bad working capital management. Just to give you some idea, friends, how does the working capital cycle happens? So we receive the goods from the supplier on zero date, and we make him a payment, let's say on 30th day. So this is a period of my payables. Now this is the date on we make the payment, and what do? This goods that we have got from the supplier, it is taken for processing, and let's say on 60th day this goods is ready, and finished goods is ready, and we ship it to the customer. and from the date on which we ship it to the customer, our receivable period starts. And let's say on 125th day we make the payment to the customer, and that means for so much of time our money is locked up. Please, please go ahead.
Yeah, money will be idle.
Yeah, money will be locked up. Yes. So, friends, please remember, based on the figure of 2017, this period for Emeris was 80. So, 80 of the working capital cycle of Emeris was 80 days, and which I am sure one would think is certainly quite high. So, what are the factors that would influence the operating working capital management? Number one, there are external factors, and in case of external factors, what you would have the economical factors, political crisis, technical changes. Now, these are the factors which are external to the company that would have an impact on the operating working capital. Processes will also have an impact on the working capital. Longer the process, longer the production process of an entity, more is going to be operating working capital. And finally, change the business strategy. So a strategy will also decide the OWC. I'm sure, friends, all of you would know this. Today, the whole world, the truly professionally managed companies, what they are doing, they are going for just in time, JIT as they call it, just in time. So just to give you an example, there's a company we all know, Maruti. Maruti is a company that produces vehicles. You know, Maruti purchases spark plug from a company called Myco Bosch. And you know what? What is the terms of supply between the Maruti and the Myco Bosch? Maruti does not ask Myco Bosch to supply these spark plugs 2 months in advance, not even 1 month in advance, not even a fortnight in advance, not a week in advance, not a day in advance. Maruti asks Myco Bosch to supply the spark plug to Maruti on shift basis. So that means straight away from the supplier, the goods goes onto the assembly line, and that is your just in time. And I'm sure you can very well imagine that if the raw material is going straight from the supplier's place to the production, that means I'm not holding any raw material as an inventory. That means I'm not locking up my capital in inventory. So friends, these are the factors that influence the working capital, operating working capital of any business. And why to reduce the working capital? I think I've discussed that already with you. Because when we reduce the working capital, we get more cash in our hand. And we have seen that when you reduce the working capital, your borrowings go down. When your borrowings go down, your cost of borrowing goes down, your interest goes down. And number 4, improve Emeris's capability to negotiate with the banks. So remember, a lesser the working capital that you have, better position you are in to negotiate with the bank. If you need more money for the working capital, that much negatively you are placed in negotiation. So these are the reasons, friends, for which we need to reduce working capital. Not we only reduce the working capital. Across the globe, these are the reasons for which companies work to reduce their working capital. Now, what is OWC improvement? And friends, let me tell you, working capital management for any business is less a matter of knowledge, is more a matter of attitude. Working capital management is less a matter of knowledge, more a matter of attitude. So we all understand very simply, if we have to have a tight working capital management, it means what? It means, simply speaking, we need to minimize the inventories, we need to minimize the receivables, and we need to maximize the payables without letting the price by the supplier go up. And that is as simple as that. So working capital management is less a matter of knowledge, it's more of a matter of attitude. And why a matter of attitude? Everyone in the organization needs to understand this, that if company is carrying inventory unnecessarily, now this unnecessary or excess inventory that the company is carrying, it is costing to the company. It is costing to the company in terms of interest. It is costing to the company in terms of warehousing cost. it is costing in terms of obsolescence. So it is a matter of attitude. So once the people become aware that if we have extra inventory being carried, if we have high receivables being carried, remember, high receivables would mean what? High receivables would mean more time spent in the follow up with the customer in getting the payment. High receivables would mean more risk of receivables becoming a bad debt.
Bad debt.
And that is what is we have to always remember, not only remember but tell everybody. Please remember, the working capital management is less a matter of knowledge and more a matter of attitude. And what is the meaning of attitude? Meaning of the attitude is that we need to be aware that any excess inventory that we carry, it is going to hit my profit and loss statement, and it is also going to hit my cash flow statement negatively. So that is why, friends, in Ameris now what we have, our project of the initiative that we have is capitalize on all BU's knowledge. Now what does it mean? It means all the business units that we have within the group, some of them are doing excellent job as far as the working capital management is concerned. So what are the best practices that they are following? So what we need to do, just pick up those best practices and copy them at the other places. Spread the good practices to enable continuous improvement, and that is what it is. So what are the key principle? Number one, the key principle is Ameris can surely improve, right? So when you think, you start getting the answers. So as they say, what you think, so you do. So if you think that it has to be improvised, it can of course be improvised. Simple actions are often the ones bringing the best and quickest results. As somebody was mentioning a little while ago, that during the COVID period, when all the businesses across the globe were suffering, their operations were suffering, and in Ameris, efforts were made to tighten the working capital, and as a result of tightening of the working capital, lot of inventories were unlocked, lot of receivables were unlocked, and as a result of that, lot of cash was available with the company. And that is the meaning of simple actions are often the ones bringing the best and quickest results. So Ameris' approach on OWC is inventory management and sales and accounts receivables management and purchase and accounts payables management. And how does it work? So it would work in this way. So one is order to cash. So that means from the time we receive the order from the customer till the time we get the cash. Now this period has to be managed. And then produce to deliver. That means so we receive the can you just give me just 1 second, just 1 minute. Looks like there is someone. Hello. Please give me a minute. Hello. हाँ, क्या हुआ सर ना? हेलो. ठीक है, ओके, ले आता हूँ. ठीक है, ओके. हाँ, ठीक है, ओके. All right. So yes, Vipashu. Yes, Vipasha. I will. You are raising a question, Vipasha. Please go ahead.
No, sir, wrongly.
All right. No worries. Okay. So let's come back, and this is where we were. So this is how we do in. So one is order to cash, and the other is. So how does order to cash? What are the areas and activities that need to be taken care of? in case of the order to cash. That means issuing quotations and contracting. So it is at that point in time we need to ensure that we convey it very effectively to our prospective customer as to what kind of payment conditions that we would have and what we expect. Risk management, processed orders and deliveries as to what how the whole process of delivery will happen. Make the invoice, and remember, so make the invoice as soon as the shipment is done, and not only as soon as the shipment is done, but also ensure that the invoice reaches to the customer, if not before the shipment reaching to the customer, at least along with the shipment. Why? Because the customer will process our bill for payment only after he receives the invoice and not after he receives the material, and that is what needs to be done. So processing payment, collecting overdues, managing disputes. So many times it can happen that there may be some dispute for whatever reason, wrong supply, in perception of the customer or otherwise. So all those disputes will need to be cleared and settled at the quickest. So that is what has to be done for the working capital management in case of order to cash. Then of course we also have something which is known as DSO. What is DSO? Days of sales outstanding. Friends, remember, days of sales outstanding is a very important KPI. And what does it tell? It basically tells that at any given point in time, how many days of sales of mine is outstanding with my customer. Obviously, this period has to be as less as possible. So as less as possible. So if I calculate my DSO, days of sales outstanding, how do I figure it out? I would figure out as to what can be the best possible days of sales outstanding. If let's say that period comes to 30 days, and if my current DSO is coming to 40 days, that means there is a scope in my case where I can bring down my DSO from 40 days to 30 days. And that bringing down to 30 days would, so much of receivables amount will be available with me, and that is how I would interpret the DSO. Please remember, all of you, the worst thing about receivable, the worst thing about excess receivable, you know what it is? Anyone? The worst thing.
They are not guaranteed.
They are not guaranteed. Okay. What else?
Yeah.
What else?
Bad debt guarantees.
Yep,
there will
bad
be
debt.
chances of bad debt.
Absolutely. And friends, I'm sure.
Working capital, interest on working capital.
Interest on
funding.
working capital. And you know what, friends? In the entire business, not only of ours, but across the world, there is one expense. There is one expense in the entire business for all the businesses across the globe. That expense does not bring any benefit to the company. See, remember, all the expenses that we incur, they bring some benefit or the other. Rent we pay, it has a benefit to the company. Travel that we do, it has a benefit to the company. Legal fees that we pay, it has a benefit to the company. The material cost that we use, it has a benefit to the company. Interest that we pay, it has a benefit to the company. But there is one expense, and that expense, remember, has no benefit to the company. And please remember, this expense not only has got no benefit to the company, but this expense not only hits the company by the amount of profit, it also hits the company by the amount of the cost of goods sold. And you know what that expense is? That expense is bad debt.
Bad debt.
Bad debt is one expense that hits us not with the amount of profit, but also with the amount of the cost. If I sold a consignment worth 2 million euros, right? And in that 2 million euros, my profit is, let's say, 0.2 million euros. And if this receivable becomes bad debt, remember, my P&L is hit not by 0.2 million euros. My P&L is impacted by 1 million euros. And that is the only one expense called bad debt, which is which does not give any benefit to the company. And I'm sure if you think about it, you would realize, yes, this is the only expense. Bad debt is the only expense. It does not give any benefit to the business whatsoever. Every other expense that we do gives us the business, and therefore what we have to do, we have to tighten the receivables management in a way so that we are able to minimize our bad debt. But not only minimize, we are able to completely negate it. Now, what?
Is it a global phenomenon or very prominent in India and these Asian countries?
No. Bad debt is a global phenomena.
Global phenomenon.
Yeah, global phenomena, and bad debt is not only a global phenomena, but it also changes the color depending on the economic state of that economy. So, if the economy is doing well, then the bad debts go down. If the economy is in a bad shape, then the bad debts also go up. So, it works like this. So what are the causes for the late payments? As you can see, litigation. In 40% of the time, litigation, payment conditions not properly agreed. So if my payment term to my customer is ambiguous, the customer is going to take benefit of that ambiguity to his advantage. So that is one reason. Invoicing mistake. I have raised the invoice, and in that invoice the quantity that I have mentioned is not correct, or the specification that I have mentioned is not correct. It gives a reason to my customer to not make the payment to me or delay the payment to me and ask for some clarification. Lack of operations. Lack of dunning operations. You know what is the meaning of dunning? Dunning means, yeah, please tell me, anyone?
I think follow up, sir.
Follow up, absolutely.
Yeah.
So dunning means systematic, methodical follow up with the customer. So first, the reminder, gentle reminder should go. If the payment is not coming, then a letter should go. If the letter is not coming, then the notice should go. If the notice is not coming, then the follow up should happen. If that is also not bringing, then the litigation should happen. So that is sometimes lack of dunning, systematic, methodical follow up also becomes a reason for the late payments. And 40% of the time it is due to bad customer faith. That means the customer does not have the intention to pay on time, or the customer does not have the intention to pay on the pay, or the customer's financials are in trouble. So that is 40%, and 20% due to financial problems. So a customer may delay the payment 20% of the time because he is running into financial difficulty, and sometimes he is not paying it because he does not have cash himself. So these are the reasons, friends, for the late payment.
Sir?
Yeah, please.
Sir, is bad debt is a allowable expenses under income tax for calculation of profit?
Very good. I think that's a very good question. That's a very good question. Can you please ask this question once again?
I said
Yes.
bad debt is a allowable expenses during calculation of profit for income tax.
Yes. So Lalatendu, is a very good question, and it goes like this. Remember, since this is a question, and a very relevant question, please remember the principle that the income tax department follows in allowing an expense to you. The principle that the income tax department follows in allowing any expense to you is the expense that you are claiming should be a business expense. Number one. Number two, that expense should have occurred. It should have taken a place. Meaning what? Meaning, if you have made a provision for bad debts in your books, income tax may not allow you that expense. And why they will not allow you? Because it's only a provision. This expense has not occurred, so they will not allow you. That's number one. Number two, an expense has occurred, right? An expense has occurred, but the income tax department can still ask you a lot of questions. Say, for example, if you are claiming a bad debt of 5 million euros, so income tax department can ask you, give us the proof that this amount is really not realizable. So maybe in that case, this company from whom this money was to be received has gone in for bankruptcy. The court has passed an order. So you will need to obtain copy of that order and keep in possession with you, so that tomorrow, in case there is a query from the income tax department, you are able to show this court order, and based on that court order, the income tax department will have to allow you the bad debt as a deductible expense. So bad debt in principle is a deductible expense. Only thing is not the provision, because provision is something which has not yet happened. So only what has happened they would allow you, and but of course they will ask you some documentary support. Second thing that we have is produce to deliver. That means from sales forecast to goods shipping. That is what would need to be done, and that is where these are the things that needs to be taken care of. So product range management, planning and forecasting, procurement and replenishment of procurement of material so as to produce and its replenishment from time to time. Sales order processing and customer service will need to be taken care of. Manufacturing scheduling and execution will have to be taken care of, so that the orders of all the customers are duly executed. Inventory management becomes crucial. Inventory management would simply mean not to have unnecessary inventory, not to have the non-moving items, and to have least of the slow moving items. Okay, and then finally finished goods warehousing and distribution also will have to be. So these are the elements of produce to deliver so as to achieve working capital management. And focus on inventories processing cost is that is what has to be done. So ordered quantities have to be sufficient enough to satisfy your needs, and not only they have to be sufficient, but they should not be in excess also, because if you have excess inventory coming in, that sits into your plant and it becomes slow moving or non moving, and it unnecessarily becomes a cost to you. So that is what is your inventory processing cost. Product range management would mean a dedicated raw material resources and sometimes packaging references impact on inventory level. So dedicated raw material resources would mean whenever we are in need of raw material, we should be able to get it without any difficulty. Multiple batch changes in the manufacturing process. So ultimately we have to do the production planning in such a way so that it is optimized. In case of purchase to pay, what we need to do is select. These are the activities and at stake: selecting and contracting, requirement and ordering. So when a requirement comes for purchase of an item, a question should be raised: is it really required? Question should be raised: is it really so much of required? And that is how it is. So these are the tracking, receiving and evaluating, processing of the invoice, managing discrepancies, processing the payments. So these are purchase to pay. So it means what? It means when I am purchasing any material, before I make the payment for that material, I need to ensure that all the terms and conditions of the POs are complied. I do not make payment unless and until I have got the material as per my requirement. Because otherwise many times what the companies do, companies dump the goods into your factory, and the moment they dump it, and if you are not careful, their meter starts from that date. So how to set the optimal payment terms? Benchmark the average payment practice. So find out as to what is the payment term that other companies in the industry have. So based on that, one can do the benchmarking, and then of course review the current practices as to what the current practices are. And in case if you are in a dominating position, in case if you are you have a position, then you would be able to even command some terms to your advantage. Do you really ask this question? Do you really need it on 30th? Can you defer it? Can you postpone it? If you can defer it, you can postpone it, then you should do it. Then of course in case this is something today, of course everything is on ERP. In case if the procurement is done manually, then there are a lot of challenges. The challenges can be with regard to the control, because manually it is difficult to monitor as to where the goods are, and also it's difficult to do the accounting, and those are the challenges in case of ERP. In conclusion, remember OWC represents frozen money, fake cash, cash consumed. That is what we should remember. So OWC is what? OWC is so much. OWC is 100 million euros. That means 100 million euros of the companies are locked up. It's frozen money. So friends, these are the points that I thought I would share with you as far as the operating working capital management is concerned. And the conclusion is communication, communication, communication. And that means make everybody aware of the urgency and the importance of working capital management, tight working capital management. When that happens, the results automatically improves. So friends, with this we come to the close of the third component of the financial statement, which was the cash flow statement, and now we have also completed the operating working capital management. Now you will have the opportunity of going back to the simulation game, and all of you can do that. All of you can do that. So you have your respective breakout groups, so you can join those respective breakout groups, and then taking into account the income statement, balance sheet, and the cash flow that we have covered already, and now also the operating working capital, you can look at your decision and rework your numbers as you may deem fit. And for that you will have a time of 30 minutes, and this you can do independently. Friends, I can sign off from now, but before I sign off, I can make it open to all of you. In case if you have any doubt, any question, you can please ask me. So once we finish this question answer session, you will go for the breakout, have a time of 30 minutes, play the simulation game, incorporating the working capital aspect also in that actually for half an hour, and thereafter you also can sign off. We will have the next session, friends, on 9th of November and on 10th of November. So 9th of November when we meet, on 9th of November we would be discussing the financial analysis, different ratios like liquidity ratio, profitability ratio, activity ratio, leverage ratio, and also how the investment decisions are taken. So what is IRR, what is NPV, what is the discounted cash flow, how the discounted cash flow is used for the decision making. So that would be our plan for 9th November. It's my request to all of you, the material which is available to you on the e-learning portal, please make full use of it. Please make full use of it. Next time when you come for the session on 9th November, you know the agenda. Come prepared with all your questions, all your queries, whatever they may be, and I would be very happy to answer all those questions and all your queries. So now over to you for next 5 minutes for all your questions and queries, and then all of you will be going into breakout sessions for half an hour. After half an hour, independently you can sign off, and then we will meet on 9th of November. So over to all of you.